everyone, welcome to our grade 12 accounting tutorial series. Today we'll be diving into a crucial part of the balance sheet, and we'll be doing this by means of using the November 2021 IEB paper. But don't worry if you're not with IEB, the concepts we do cover are universal. We'll be looking at a portion of the balance sheet section, and understanding what the balance sheet section is essential in this. And what it is actually just a financial photograph at a specific time. It shows what we own, which are our assets, what we owe, which are our liabilities, and what's left over for the owners, which is the equity. What we'll be delving into today is the equity. We'll be looking at two important notes, which is our ordinary share capital note, as well as our retained income note. Our ordinary share capital reflects the total amount of money that is invested in a company by the shareholders through buying shares. Broken down, what this means is that when shareholders buy shares from us, when they invest in the company, our equity increases. And that is what ordinary share capital shows. But when they sell their shares back to us, or something happens and we need to buy back those shares, our equity decreases. Essentially, we have less investment when we buy them back, and we have more investment when we sell the shares. And that is what is happening in the ordinary share capital. To understand the buyback more clearly, think of it like when a company buys back its shares, it's essentially returning some of that invested capital to shareholders. Okay, hence the buyback is a decrease. Okay, the next part is the retained income. The retained income account reflects the company's accumulated profit. So what makes this difference to our net profit after tax? Because that is profits. The retained income takes into account the dividends, which is the money or the payments that are made by a company to the shareholders. It also takes into account the buyback expense. So what is the buyback expense? The buyback expense is simply how much more than the average share price did we buy back our shares for. We'll just take a quick example, a small little example on the side. So what happens is, let's assume that the average share price of certain shares is 5 Rand per share. And let's say this amount that we're looking at, this is how much the shares are, the ordinary share capital is worth. So how much the shares are worth. We then buy back these shares for some reason, whatever reason it is, we buy back the shares. And our buyback price is 8 Rand. So that means we bought it back for 8 Rand minus 5 Rand, for 3 Rand more than the average share price. This will then, because it's more than the average share price, it means the business is technically using more money to get these shares back, when we're saying, well, at this point the average share price is 5 Rand. This 3 Rand then becomes our expense. How much more we had to buy, how much we as a company had to take out in order to buy them back. That's an expense, and this will go into the retained income account. So the 3 Rand, just the difference, will go into the retained income. And the average share price is what will show up in our ordinary share capital account. Okay, perfect. So then what actually continues to happen after we've said this? What we're saying here is that the buyback per share is equal to the retained income expense, right, E, this expense, plus the average share price that we see in the owner's share capital. So this will be our little cute formula that we're just going to remember, that if you have to work out the buyback per share, it has to be the expense plus the average share price. They will always equal. Great. So now let's go into the work. what we start with is Lesedi Limited is a South African listed company with an authorized share capital of 7 million ordinary shares. What this simply means is the authorized is what the company is legally allowed to issue. So the amount of shares that the company can legally issue. That is simply what it is. And remember, this amount does not go as your starting amount in your ordinary share capital or in your retained income. This is just saying this is how many shares the company can legally issue. The company cannot issue more than 7 million shares. They're not allowed to legally. We then want to check what is the duration of our financial year. So we're told that the balances on the 1st of March 2020 are the following amounts, and we're also told that the trial balance for the year ended 28th. That means our financial year goes from the 1st of March 2020 up till the 28th of Feb 2021. Remember, this is always on the last day of the year. On the last day of the year, or we say on the last day of that month. That means if this was not the 28th and it was a leap year, so writing 28, you'd write 29, 02, and whatever year it is. Okay? So now we know the end and the beginning. The first transaction we're given is that on the 1st of March 2020, there were 4.5 million ordinary shares in issue. Great, so that's our beginning balance, right? So we're going to go here and it's already given to us. But what we want to do first is to see what is the average share price. And to get that... Hey everyone, welcome to our grade 12 accounting tutorial series. Today we'll be diving into a crucial part of the balance sheet. And we'll be doing this by means of using the November 2021 IEB paper. But don't worry if you're not with IEB, the concepts we do cover are universal. We'll be looking at a portion of the balance sheet section. And understanding what the balance sheet section is essential in this. And what it is actually just a financial photograph at a specific time. It shows what we own, which are our assets, what we owe, which are our liabilities, and what's left over for the owners, which is the equity. What we'll be delving into today is the equity. We'll be looking at two important notes, which is our ordinary share capital note, as well as our retained income note. Our ordinary share capital reflects the total amount of money that is invested in a company by the shareholders through buying shares. Broken down, what this means is that when shareholders buy shares from us, when they invest in the company, our equity increases. And that is what ordinary share capital shows. But when they sell their shares back to us, or something happens and we need to buy back those shares, our equity decreases. Essentially, we have less investment when we buy them back, and we have more investment when we sell the shares. And that is what is happening. Okay, so we now have that, and previously we've already said that our average share price at the beginning was R2.40, correct? So what we're left with is ordinary shares, these ordinary shares which account for our buyback of 25,000 shares at R2.95. So we're going to put 25,000 shares here, right? And we're going to put the subtraction, but we don't know how much it's at, because remember we always put at average share price. So this was at average share price at the beginning of the year. But because we had extra shares that were issued before the buyback, we need to add it in order to get our average share price now. So our average share price at the time of this buyback was our 10 million 800,000. To that, we're going to add our 4, not 4, sorry, the one we just did, 1.4 million. So that's okay. 1.4 million. Divided by that, we're then going to add our 4.5 million. And we're going to add our added, which is 500,000. This will give us an average share price of R2.44. This average share price is what's going to go into our ordinary share capital. Okay, so now we've got this amount that goes into our ordinary share capital amount. We need to know what was our expense. So the buyback was at R2.95. So now what is our actual buyback? So remember we said the cute formula, buyback is equals to average share price plus expense. So to get our expense, we're just going to say R2.95 minus our average share price, R2.44, and that's going to give us our expense of 0, or let's write expense here instead, and that's going to give us 51 cents as our expense, i.e. the amount that's going to go into retained income. This amount goes to ordinary share capital, so then we'll enter the amount. So over here it will be at R2.44. Then you're going to say R2.44 times 25,000. Alright, put that in your calculator and you're going to get 61,000. And we subtract. And then we work out the final here, the end, which is 4.5 million plus 500,000 minus 25,000, which will give us 4,975,000 shares at the end. We're going to need that when we get here. Okay, so firstly we need our net profit before tax. So we're just going to write this as this has been previously worked out at the start of this question, not within this video. So that'll be 1,289,540. So this is our net profit before tax. We then need to remove our buyback, so we're just going to say buyback and then say how many shares, which is 25,000 shares at 51 cents, and that will give us 12,750. If you chose to write this in cents, let's say you decided to write it like 51 cents is equals to the expense. Remember to always show this with the 0,51, because if you say 51 times the 25,000, you're going to get a completely different answer and a completely incorrect answer. So always remember 0, to put the 0 when you're doing cents. Then with our ordinary shares, we were given the first part, which is the on the 1st of December we had a paid of 425,000, so that'll get into here, 425,000, and we want to know what the recommended is. They told us that the recommended is at 14 cents of the ordinary share capital at the end. So we're going to take the ordinary share capital at the end, which is 4.975 thousand, and multiply it by 14%, and this will give us our dividends of 696,500, which we're going to enter in here, and we will then add up these two and get an amount that we also subtract, and that'll give us the balance at the end, i.e. our accumulated profit. So key things to note here, are that your ordinary share capital, if our buyback is an average share price, if there is an issue of shares before the buyback, you need to add all of that in order to get our average share price. Whereas if there is one after, we are not going to add it in order for us to get the average share price. Never forget that your total buyback amount won't go into your ordinary shares unless they say the buyback was at the average share price. We bought it back at the same price as the average share price. Otherwise, we need to do buyback as equals to average share price plus the expense, and the expense is how much more than our average share did we pay. Additionally, don't forget your paid dividends is what did we pay during the year, and your recommended will always happen at the end of the year, most likely. Your recommended will have some specifications. You might be told that at the end of the year, we had a recommended dividends and maybe only 75% of the ordinary shares at the end of the year qualified for dividends, and so we'll have to calculate it at 75%. So read the questions, and from there you decide what you do. Thank you. Do ask if there are any questions, any queries, any remarks. Thank you so much. See you in our next video.